So this starts our discussion of um, chapter 1. Um, and generally, I'm going to presume here that you um, have some vague memory of your principles of macro course. Many of you used the ManQ text, the same author as wrote this intermediate textbook. And so what we're going to do here in the first 2 chapters is kind of just review what you'd already learned before. So that's essentially what our goals are here. Okay. At its most basic level, let's just remind ourselves of what macroeconomics is. Macroeconomics is, again, the study of the economy as a whole. These would be some of the, questions you could imagine one asking. They would all be macroeconomic questions. But again, it's talking about, for the most part, the economy as a whole. It's probably the kind of economics you hear about most often in the news. It would be the kind of economics that investors think about most often when they're thinking about stocks. Of the two, microeconomics and macroeconomics is younger. It largely gets its birth as a field of economics with John Maynard Keynes in the 1920s, 1930s. Again, these would be more questions you could imagine a macroeconomist asking. My general sense here, as I go through these slides, it may seem like I'm going through it quickly. Well, it's going to be especially the case in these first 2 chapters where I'm kind of presuming you remember some things, but also you can read slides. You don't need me to read for you word for word what's going on here. It's my job more or less to just talk about it, just chat about it, and especially for these first 2 chapters, they're going to be a bit more on the shorter side. Okay, so if we think about what macroeconomists measure, for the most part, they're measuring 3 things. They're measuring production, which we measure as gross domestic product. They're measuring prices, which for the most part we measure with an index, the most popular index being the Consumer Price Index. And then the third thing is we measure employment. With most of our attention being on measuring unemployment and more specifically what's called the U3 statistic of unemployment. So, we've got this data here, but this data from the publisher, it's kind of old. This is the website to go to for really cool data. Let's just try to go to it now. Hoping that... There we go. And what's nice about Fred is you get the really cool charts that you can then download, you can edit, you can do lots of things. So for any of your economics classes, if you have to do a paper, Fred is a fantastic resource. And we can see here that in the second quarter of 2021 that we have about a, for the most part, a $22 trillion economy. 22,722 billion 581 million. But what you can see in this, and you could see in the other chart as well, are fluctuations. One of the jobs of an economist is to measure those, find out the cause of them, and then how to resolve the situation. So the fluctuations they become a focal point, meaning that lots of the discussion that we have as macroeconomists become oriented around what caused the change and how do we resolve the change. Here's inflation. Again, most of the focus here is not even so much on the fluctuations, but points where it's incredibly high and points where it's incredibly low. And then with unemployment, same thing. Points where it's high, points where it's incredibly low. How do we explain that? How do we manage the economy? That's a lot of the job of a macroeconomist, is to manage things. You know, politicians, the public have a goal, right? They want high employment, they want low inflation, right? And so the economist then becomes the person who's just trying to achieve that. Well, measure it and achieve it. How macroeconomists do this is with models. So economics as a discipline as a whole tries to be a science. And so in this portrayal of itself as a science, there needs to be models. And what is a model? A model is a simplified version of reality, which of course is incredibly complex. And the focus then becomes on relationships, meaning correlation and causation. One example of that being that one thing that macroeconomists believe is that investments in infrastructure, investments in capital leads to economic growth. And so when a government invests money in infrastructure, it generally does lead the economy to growing. And an economist would then be hired to figure out how much investment to do to get a certain growth level. The models that you've looked at in principles are pretty simple, with one of them just being supply and demand. Now, when we look at supply and demand, the one thing we realize is that there's lots of things going on that's going to impact the price. It's not just one thing. And that same thing then is true when we're talking about things like unemployment or inflation or even just production levels, is that it is a simplification of reality. And that there's going to be lots of factors, many of which we don't know what they are, that determines whether an individual is employed or unemployed, or why prices for a particular good have increased. And in that simple model, we can then see we need to think about in some way the relationship between variables when we're talking about a model. Well, here what we're saying is that cars that how many cars are purchased is in some sense a function of or related to what is the price of a car and how much money do people have. For the most part, we think that if the price goes up, people buy fewer goods. As the income level goes up, people buy more cars. Again, that's useful for an economist to know, because then that would mean that they can advise the car manufacturer about the appropriateness of changing the price. We really don't need to worry about this. Now, one of the things you would have done in principles is that then you would graph out what does that relationship look like. And that's where we get our demand curve, which is just showing the relationship between the price of cars and the quantity of cars. That it is downward sloping. That would be what you remember as the law of demand. That there's an inverse relationship or an opposite relationship between the price of it and the quantity. Now, from the supply perspective, it's different. Now we're talking about how many cars are produced. And if the price of cars is high, manufacturers are going to want to build a lot. And if prices are low, they're not going to want to sell as many. That relationship where I talked about one variable going up, the other one going down, or both going up, that is a model, a hypothesis of the way that the variables are going to exist with each other. Now, economists with that supply curve and demand curve are going to focus most often about the equilibrium where supply and demand meet, because that's going to then determine the market price. Equilibrium as a term having a meaning of no tendency for change. Once it's at this equilibrium, it kind of just sticks around. The only thing that can change the equilibrium is if we shift some of the curves. So if we gave everyone more income, the price of cars will go up. And we can see that here. Because if you increase income, that's going to shift out the demand curve. And now get us at higher equilibrium. Just remember, when we say movement, we're talking about movement along the curve, as opposed to shift. I just add that little S prime just to denote it's the second one. You could also just call it S1, S2, whatever you want. Movements only occur because the price changed. Whereas this shift is where it's something other than price changed. And that's what draws that. Here's another example where they're going to talk about the steel market. I'm not sure exactly what you need for me to belabor this point more. One of the key ideas when you're building these models is trying to determine what are your endogenous versus your exogenous variables. Endogenous variables are determined by the model. So there's not a lot of that is the goal of the model, is to determine those endogenous variables. And then the exogenous variables are kind of where it gets a little messier, because these are basically coming from the outside. They're outside the model. We just wouldn't know what they are or what it is. And here, in the case of supply and demand, we'd be talking about the price of the good and then the quantities. That's only true. Those are the only endogenous variables in the in the simple demand and supply curves that we created. When we're talking about things being, again, exogenous, it's from outside the model. We're not trying to explain what the income level is, what the price is for the supplier to produce the good. That's not up to the macroeconomist. Sorry, again, I'm not trying to skip things, but again, you can do this if you want to. One of the things that is useful is when you're thinking about a model, you should really truly think about the assumptions that are being made and whether you can live with those assumptions. In that process, you're identifying the variables that are endogenous versus exogenous. And then what can we use that model for? After we've built this model, what is it going to help us understand that we didn't have a way of understanding before? So one way one of these models that we see that actually comes from John Maynard Keynes is all about how quickly do prices adjust. Well, we don't know, and the model's not going to tell us. It's just something that's done, in terms of measuring how long things are. So, we start with part of the model where we say that markets do clear. Markets search for a point where buyers and sellers can come to some sort of agreement on the price. Once you determine that, you're not just going to go and change it right away. So that would mean that for the most part, at least in the short run, many prices are sticky, meaning they don't move as quickly as we would expect them to. Now, before you think that, why do I care whether prices are sticky or not, it actually matters a great deal. Okay, to continue. So we're talking about sticky versus flexible prices here. One of the things that, when we build this model of whether we're going to believe this model or not is, what do we see around us? Do we see prices immediately adjusting in that they're flexible? Or do we see some sluggishness, some slowness of prices changing? Most economists do believe that prices are sticky. This is a Keynesian notion from John Maynard Keynes. Born on my birthday, by the way, June 5th. As is Adam Smith. And myself. So that's 3 Geminis. Most economists believe that prices are sticky, that they do move a little bit sluggishly. To the extent that that's the case, actually then determines a lot of other things, like unemployment. It turns out that a lot of the unemployment we saw after some of the worst parts of COVID actually came from the fact that prices still reflected a world where there were all these workers out there, and the workplace wasn't as dangerous as it is today in terms of catching a disease, potentially deadly disease. So prices were too low. Wages were too low. So people weren't going to work. I hardly blame the workers for that. So, we will, for the most part, in this course, this week and next week, we're going to start with the introductory materials. You can think of that as a review of Econ 131. Then we're going to look at least start the introduction to the classical theory, and then we'll have our first exam. And then we'll pick up with the second exam, continuing our discussion of classical theory, and then starting to talk about and then talking about growth theory. And then we finish up this course by kind of taking a selection of business cycle theory, macro theory, and macro policy. So part one, and it's also a little bit of part 2. This is part 2, and this is part 3 of the course. Okay, I'm not going to read the summary or anything like that, but what I hope at least you see in this first chapter is that models are important and are what we're going to rely on here in macroeconomics, and that what we're going to start off by looking at is the classical model, and then we'll transition to growth theory and then business cycle theory.